The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and that music means it's once again time for the Option Block, and this is our final show of the year, so we're going to do something a little bit different, but more on that in a second. Let's start off with introducing the panel. Starting off with here, we're doing it live today, so it'll be nice, fun. Everybody in the room and drinking heavily, so that always makes for a fun show. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network, upon which many of you are listening to this program right now. And joining me to my left, physically this time, for the first time in a while that I could say that, is the man from the mountains himself, coming in all the way from the St. Charles Scenic Satellite Office of Know Your Options. He is none other than Uncle Mike Tusaw. Mr. Tusaw, Mr. T, welcome back to the program, sir.
Always excited to be here. It's something, these buildings here in Chicago are really tall, and y'all have running water here, too.
You know, we don't have to go outside and dig those ditches. It's nice.
Man.
They should look into that in St. Charles, you know? It's not that far out. They could do a few of those things. And also joining us live here on the end of the table is the man holding down the Options Express hot seat today, good old John Grigas from Options Express. He is the major domo over at the trading desk there these days. Mr. G, welcome back to the program as well, sir.
Good to be here. Good to be in the Know Your Options office. Pretty much impressed. That's all I got to say. 2.5 blocks down the street from Options Express. Quick walk across the river. But it's good to be here. It's good to do a live show to end up the year. And I think I know why Tusaw's in the office. We haven't had any snow here in Chicago, and those snowmobiles don't run on withered grass.
Yeah, so. I can tell you what, the last week of the year, if we'd had snow on the ground, I would not be. I'd be having my portable computer with me on the snowmobile, looking at the markets while I was trading.
Yeah, those little kiddie mobiles that we were talking about earlier in the year. I'm sure didn't get. So they probably got some use earlier in the year, but so far, and I'm thankful for this. Maybe some others may have different opinions, but so far it's been a relatively mild winter. No snow to speak of yet in Chicago going into the new year. So that's always a plus in my book.
I have a prayer request for all of our listeners out there. Pray for snow in Chicago. We need it. We need the snow. The trails are bare. It is so sad. We need it.
No snow for you out in the hinterlands. We need clear walkways and bridges here downtown.
It's got to be 45 degrees out there right now.
I know. It's sunny. It's fantastic. I don't know what to do with myself. All this warmth and giddy sunlight at the end of December in Chicago. All right, and with your weather report for the year taken care of, we're going to roll right into our, I suppose you can call it, we're doing something a little bit different this show, since this is our final show of the year. We're going to take a look back. I'm going to kick things off, actually, with some of the big trading trends of the year. And welcome to our Trading Trends segment. This is the portion of the show where we're going to mix things up a little bit and talk about what we've been watching, trends we saw developing, and just interesting shifts we saw in the marketplace over the past year. All right, guys, so this is something new. We haven't really done this before, but it is interesting to kind of think back and kick back on the year's major trends, major interesting shifts we saw in the options space since we started doing this show in the beginning of the year. And it's like we like to do in the trading block, maybe we'll kick things off here talking about some general trends in volatility and the good old VIX. It has been, I think to call it a rocky year for VIX would be an understatement of epic proportions. It's been up, it's been down, it's been left, it's been right, it's been sideways, it's been moving in correlation with the market, in lockstep with the market. It's been moving adversely to the market. It's been doing everything you could possibly want or not want it to do over the past year. It's been a glorious or perhaps painful year, depending on your point of view, for watching the VIX. Looking back at the start of the year, what were maybe some of the major interesting trends or developments that really caught your eye in VIX over the course of the year?
Sorry. The thing that I noticed about the VIX this year is that it actually didn't move in opposite lockstep of the market like a lot of people assume. Now, don't get me wrong, a lot of times it does, but and I've talked about this on the show a lot of times, if you're using the VIX solely as a hedge, it's not a true hedge. It can be like a pairs and a short-term trading account, but if you're trying to hedge your nest egg, I think by using the VIX as a hedge on your nest egg, it's like buying car insurance on your house. And this year that held true a few times.
God, he loves that analogy, doesn't he?
I really do.
I think one thing, too, is that...
Because nobody believes me when I say it.
Well, wait till I get in a car accident and I'll try to put in a claim.
I prefer the boat insurance on the house. I think that works a little better.
Goat insurance?
Boat.
Okay.
Or goat.
Boat insurance. Or goat.
I often insure. I don't know what you guys insure out there in St. Charles, but we don't insure our livestock very often here downtown.
But I mean, we used to talk about the VIX at the beginning of every show, and remember, it was always, I think we hit a new low, 15 and a half, 16, 16. First 6-7 months besides the earthquake in Japan, I mean, the VIX was below 20 the entire time. So I think now that, when it jumped in late July, early August, and we peaked over 40, that it has become front and center on a lot of the talking heads and CNBC and Bloomberg. Well,
they've always tossed it around on those channels as kind of, the fear gauge, because it's sexy to say fear gauge, fear index. It catches a lot of attention. They would always, as they've always said to my great consternation, they never really talk about it in context. It's just the VIX is X, the VIX is Y, and that's pretty much about it. There's not much analysis really beyond that point, but it is interesting to see for us in our perspective, how you're right, the tsunami did kind of kick it off to a degree. That was back, what was that, March, the tsunami? March. And so that was really kind of one of the early events. And speaking of the events that really started kicking off volatility this year, we had of course, the tsunami. We had our Arab Spring really rampaging and cutting through and just kind of reshaping the world of the Middle East and sending vol on a rampage. Of course, as an upside of that, who can forget the quote-unquote day of rage that we were all so concerned about?
That's right. Oil was supposed to go to 160 that night, I remember.
People were lining up to buy 200 strike calls on the crude. There was open interest that far up, and a lot of it. Yeah. And I remember we talked about it on that show that day of how insane these people were and just buying the definition of lottery tickets. And yet there was sizable open interest at the 200 strike on crude. And I can't remember how far it got, but it didn't get anywhere near that range. So, yeah, a lot of interesting developments helped spike that volatility. And, of course, going into the end of the year here, we've seen VIX doing all sorts of interesting things, including a lot of interesting paper flow. We're going into, let's say, middle to early Q3 of this year. We saw a heavy predominance in the SPX of downside put selling, which kept the VIX kind of in check for a degree. But even people doing it probably to a degree that they probably shouldn't have been, given all the developments we started seeing in the marketplace. And then the past few months, post-downgrade in this new world of 30-handle moves in the SPX and 400-point days in the Dow on a regular basis, people have finally started coming in to buy that premium again until, of course, the past few weeks when the VIX kind of hit that perfect storm of seasonality and paper flow, and I think everyone waking up all at once and realizing, hey, we can't sustain a VIX of 35 with these sorts of movements. So it all kind of combined to wipe that index away. it's funny to say the high teens is a low. Oh, that's so low in the VIX, but it just shows how our frame of reference has completely switched over the past few months. Yeah, that was probably on record as one of the worst trades of the year, and for a couple of reasons. It was one of the most ubiquitous trades of the year because everyone and their mother was contacting us up at the Options Insider, and probably you guys over at OX and you guys over here at KYO as well, and just saying, hey, this debt deal is going to be signed. We have to load up on downside here in VIX. So this thing, one way or the other, they're making a deal by the deadline, and this thing's going to implode. We want to get in on it. I think your cohort there, Mr. Sebas, may have been on that short VIX train as well for a while there. And like everyone and their mother was just diving in to get short that VIX. And, of course, we saw the deal did get passed, but, of course, we had the downgrade shortly after, and then it was off to the races from there. And all those people who had bet so heavily on that downside VIX ended up having to roll, and if they were very stubborn, they rolled all the way into pretty much December when it finally started to pay off. But I'm sure most of them were shaken loose well before that, well into October and November when they finally gave up the ghost. So I think a lot of people gave up a lot of their trading year betting heavily to the downside in VIX, that something was going to materialize that didn't. And of course, I think one of the other big trends we touched on a lot on this show, particularly for options, I think we discussed this probably on a ratio of 1 out of every 3 shows, I would say, would be Apple. Everyone and their mother was trading Apple. They're legging into verticals. They were picking up premium. They were selling downside premium, a lot of them. And it was probably our topic du jour for the show this year. It just seemed like every time we even had some guests coming on to discuss their myriad strategies about Apple. So as Uncle Mike, as probably the leading Apple devotee here amongst us and one of the leading traders in Apple for the show here, let's look back on that a little bit. I mean, obviously, a lot of your clients were pulling you into Apple this year. That was kind of the big trend of the year, at least for retail and equity options. And yet we're starting to see that tapering off. Is that I know you guys here at KYO have started to become a little lukewarm here on Apple. So I guess the first question is, are you guys still as heavy into Apple as you were? And then B, are you still seeing as much demand and interest from your clients in Apple, or has that started to taper off as well?
The interest in demand has definitely tapered off quite a bit, but in terms of our position sizing it's pretty similar to how it's been all year in terms of the amounts of shares. Now we always are adjusting the covered calls and the puts and that type of thing because everyone we have in Apple is collared. But to answer your other question, we are still lukewarm, and I'm waiting to see. I want to see what goes on in January with Apple before we really make a decision on whether we're going to pull the plug or start to scale out or that type of thing.
So still wait and see there in Apple land.
Yep.
What about you, Mr. G? Are you still seeing the flood of calls coming into the desk saying, I got to get into Apple, got to get into any price, any vol level, I don't care, get me into this beast?
We're not, actually, and I'm not sure why that's the case. Maybe it's because Apple's been in a range for the last 5 months.
Yeah, it hasn't really.
And
so for the premium seller guys, that should be a
yeah.
bonanza.
We're not seeing those straddle and strangle sellers or condor sellers. Retail, a lot of people do like the condors in the retail environment, but what we used to see in this, we'll talk about this in a few minutes, was like gold and silver. Buy out of the money calls and buy a lot and go all in. I just put $5,000 in my account. It clears tomorrow. I want to buy it. Have you ever
load me up maximum?
Yeah. Have you ever traded options before? What's your strategy? Where's your target? Where's your stop loss?
My strategy is to make money, so buy gold.
Do you have a maximum button I can just click? Buy maximum?
Can I do options on margin?
Yeah, I mean, if they could, they would.
Yeah.
I mean, that's the enthusiasm we saw at the beginning of the year, and that has tapered off. But I think there's other darlings out there. Netflix was one of those that collapsed in the middle of the year. But we're seeing, and I know KYO has mentioned this too, but CMG people like.
CMG, we hinted on that one on this show a number of times. That's always kind of been, at least to us at the Options Inside, is kind of the stealth Apple. It had a similar price level for a long time there, similar vol levels, similar trajectory. It was moving on a steady upward pace, steady growth, steady sales, and yet it didn't get anywhere near the. I guess burritos just inherently are not as sexy as a cool, new, shiny gadget or gizmo.
Well, the wife and I ate there yesterday for lunch. She came down,
there you go.
She came down to visit me at work because my boss is out of town. So I got all the time in the world. But, great burritos, but I think it's more of I wouldn't say a fad, but people like that they're eating at a trendy Mexican place that overcharges you, like Starbucks.
Well, they had that kind of the guiding hand of McDonald's behind them for a long time. The McDonald's spun them off. And a lot of people would never think going in there that was a McDonald's operation for a long time.
I think if they knew, they would probably stayed away.
It would have been like the McBurrito that was back in the day, or all those other things they tried to add Mexican food to the McDonald's menu. But yeah, it was Chipotle. We've been in and out of them forever since they were post IPO, and then they got up to I think around 150 or so, and they came right back down to about 60 or 70 handle again, and then never looked back. They kind of came right back up again. So ever since that point, they've been looking very much like Apple. And we've seen a lot of people employing a lot of interesting strategies out there. Selling downside has been relatively popular, as it is across the board, because it's been a relatively safe strategy out there for the most part, unlike Netflix. They had for a while there, they really had a lot of areas to expand in. I use a lot of, when I look at that one, I like to use the old Peter Lynch metric of, if you're looking at a stock fundamentally, you go sit in the parking lot and see how they're doing from a customer basis. And we did that a lot with Chipotle, checking out the various locations or places. There could be locations here in Chicago. And for a long time, when we were trading them early on, they were definitely unsaturated. There's only a couple in the city, and now if you go every 3 blocks, there's a Chipotle now. So they might be reaching that saturation point. Maybe they've hit that upside of the curve like Apple has as well.
Do you have one out in St. Charles there, Mike?
Yeah, I prefer the jalapeno grill.
They do have one in St. Charles. Okay, so that's it then.
Because they just
officially
locals. Yeah, I like the jalapeno grill. They do much better.
When even the mountain men can get their burritos, then I think we know Chipotle might have hit the tipping point.
I even have jalapeno grill on my cell phone.
That's a cell phone from like 1986. I like it. That's a good one. That's a flip. That's a old school slider. I like it. For such an Apple man, I figured you'd be loaded to the gills with iPhones and iPads and all sorts of other.
I like the stock. I didn't say I like the products. Big difference.
I'm an old school sliding phone man, says Uncle Mike. That's what you need. That's rugged. It can survive the snowmobiling out in the snow and when you're hunting for dinner. I
actually have problems with This is the other reason why I'll never buy I shouldn't say never, but I'll likely never buy an expensive cell phone, because of the fact that I abuse my cell phones. I've dropped 2 of them into lakes. I've crushed one of them in the seat of my car, and I don't get along with my cell phones for it.
I'm pretty abusive as well. This Droid X has managed to survive for a while now. Not that I'm plugging Motorola products. This episode brought to you by Motorola Droid. But yes, so this one survived without a case, ironically, which is a long time. Wow. It survived my little guy, too, which is saying a lot. He threw my last iPhone down an elevator shaft, so that was my cue to upgrade. He's like, Daddy, you need a new phone. But yes, a lot of interesting trends. John, you also touched on one of the big ones for retail in the equity option space. Of course, the Widowmaker itself, good old Netflix. What percentage of your time this year would you say was devoted to having customers selling downside premium in Netflix?
Yeah, a good 20%. I mean, wow. I can name 5 stocks that take up 80% of our day at Options Express, and they are the movers. They are the ones that get all the headlines. I think I always touted Netflix going into this entire year, and obviously it was an easy call, I think, for everyone when he made the CEO raised prices by 80%, and then people are fickle in that type of environment, and they left. And now that the stock is about $58, somewhere right around there,
somewhere around there, $60
from a high of 300. I mean that's a pretty amazing move. But we don't get any calls on this anymore.
That's what I was going to say. I think a lot of those guys who were hitting those weekly puts,
they're gone.
That dice has been rolled, and that house has been mortgaged to the bank.
Yeah, hopefully they saw the sign and got out and moved on to other trades and other underlying securities. But we do not get any calls on this. There's no bottom feeders. There's no premium sellers. It's done.
That one has the ghost. The ship has sailed for Netflix, and hopefully it didn't run you over on the way out of the port.
It cost me $1,400. So.
And then, of course, the other big trend, speaking of selling premium in the weeklies and Netflix, so just in general over the course of this week, is just everyone on the retail side in the equity option world just hitting the bid on any weekly option they could find. It's just amazing how much of the liquidity has migrated into that front week selling. I mean, it seems like all of the selling activity these days is going on in some downside weekly puts in one of these top names out there. I mean, you probably still get a lot of those calls.
Yeah, I mean, weeklies at Options Express probably account to between 15 and 18% of our entire volume.
Wow. And of that 18%, 99.9% sales, would you say?
the majority, but I wouldn't say that either. I mean, it's just a great product. I'm still surprised that there's only about 80 listed weekly options right now, for what I saw on the SIBA website. But I mean, they took off day one. And people are seeing that they could buy leaps and write weeklies against them and get more of a premium total than they could if they just wrote the monthly against their leaps. Very popular, and I hope that they expand it because it's only good for us. The only downside is now
expiration every week. That's great, baby. You want to come in on 7 in the morning every Friday, right?
We don't even do contraries on weeklies because we got to be here at 9 o'clock to notify the OCC. So,
made your life. I'm sure you got that weekly bonus check coming in from OX/Schwab to compensate you for all your extra work.
Yeah, instead of getting the complaint once a month on why did you blow me out 5 minutes before the close, because I have in the money, weekly Amazon calls worth $400,000 and I got $800 in my account. Now I get that on every Friday afternoon, so that's nice.
There are worse things.
Well, what I want to see with the weeklies, every time we mention it, I think I'm gonna gripe about this because hopefully something will happen on this. Let's get the weeklies out in advance instead of just having every Thursday. Let's get them out
like the futures options, right?
Yes.
Just going to say the exact same thing. You see a much more nuanced rollout on the futures options side. I think that's why whenever I talk to those guys, of course, we do a show with the CME every month about futures options, and one of the things we talk about all the time on that show is how people use the weeklies there in a much more nuanced way. They actually buy premium every now and then. Call it crazy, but I think one of the reasons they have a little bit more of an end-user customer base for those products, but also it's a more nuanced rollout. They roll out the entire month's worth of strikes at once. You can see what's coming. You know what's there. You don't have
I would love to see 2-week options.
Exactly, at least 2 weeks.
Love that, yeah.
Right now, it's kind of, I think they've helped foster this hit the bid and run away mentality by just the way they just surprise the market everywhere. Here we go. That's what you got. Hit the bid before it's gone. Oh, it's gone. You missed it. It's 8:35 and he's already down 10 vol points.
You're like a kid at Christmas at 8:30 every Thursday morning. It's like, what are we going to get? What are we going to get?
It's got to be a little scary for some of those market makers and those DPMs firms when they first open up those bids in the morning. All of a sudden, the people hit it too much and then they can bounce back and you can trade around it. But the predominance of your liquidity in the first opening sessions of those names is just going to be all maybe one buy for every 10 sells coming in on those. So you definitely have to plan accordingly. It reminds me when I was trading Intel and back on the floor, and no one would ever buy upside calls. They would only just dump upside calls on us all day. So if you ever ended up buying them, you immediately had to look to scratch it to move on to the next trade. Otherwise, you would just be so long upside skew, you would end up choking on it, and quite literally in some cases. so that I imagine the DPMs and market makers in these products have to do something similar, where they really they've learned from previous months and cycles that they need to incentivize some buying on that opening rotation. And I think the last probably big trend we saw from as equity options and also futures options and others as well is just the migration of a lot of these retail equity options customers into other sexy hot products this year, like the metals, like the ags. Primarily those were people were migrating into the ETF options for the most part, but on the ags, some of the other ones, it was in the futures options as well. Uncle Mike, you're a big follower of the metals. Would you say that trend is, we'll get into the predictions a little bit later, but that was probably the biggest. Mr. Griegus spent his days on Netflix downside puts and weeklies in general. You spend the bulk of your days rolling your upside calls in the metals over the past year. That's pretty much been the big trend for you.
Well, it has, and this is one where if you look at gold over the course of the year, it's up about 10%, give or take a couple of bucks. I didn't see the exact close today, but we're up about 10% year to date on gold. And it's one where we went real high in July and August, and I think that was a very big boom time where a lot of people were getting into gold. And then with silver, what it did this year, what I originally had intended for gold was to have about this much rate of return on it this year anyway, but not this wild of a ride.
It hasn't been just a gentle rally up 10%. No.
Well, it has. And what's interesting about gold with how we collared it, because of the fact that in July we made a decision that we were going to scrap the collar and just go with a married put for the month of July. Because when gold started going up $30 a day, I just couldn't keep up with rolling up all those calls. It was just ridiculous. I'm like, all right, we'll just roll up the puts whenever it goes up, and it's a lot more efficient that way. Typically, we don't like doing that, but it paid off for us. We're at a point now to where we got what we had hoped to get out of gold this year, but not in the way we were planning on getting it, if that makes sense.
A little higher BBI than maybe you anticipated along the way.
Yeah.
Rolling the married puts is probably never anyone's first choice for doing it, but it works in the end of the day.
Rolling them on the way up, I'll do that all day. If it wants to go up like that, great. I'll be happy to roll them. And then with this downturn, our hedges are actually ahead now. So we were behind in terms of if you were to track what our portfolios did versus what what GLD has actually done over the last couple of years, we're actually ahead of the game, not by much, just by maybe 1 to 2%, if that. But still, we've been able to capture most of the upside of gold over the course of the last 2 years while being very tightly hedged.
And Mr. Grigas, are you still seeing that crazed influx? You said you spent a lot of time putting people into upside calls, buying the max in gold upside calls. Are you still seeing that crazy influx there?
The gold fever has subsided a little bit, but I mean, that was...
silver fever for a while there earlier this year.
Talk about a PBI.
Yeah, or the Netflix was the Widowmaker of the equities. I mean, gold and silver definitely were. I mean, we couldn't raise margin requirements on both of those products, those commodities, fast enough. I mean, every night we were sending emails out, we're 20%, another 40%. And at one point, I think we were 2 times for silver. I think it cost $45,000 a contract. And 9 months ago at the start of the year, it was under $10,000. Never before have I seen anything like that where you had to raise margin requirements that much. People get me in at any level, not really on the GLD side, but people were actually trading, the futures options, the physical commodity. I saw a lot of people make money, tens of thousands, hundreds of thousands of dollars. But honestly, like when the retail, not the retail, but when the majority of people are getting in, that seems to be the top. It did give us a kind of a nice double top there. So it gave even those people that bought on the first dip a chance to reclaim some of their money or make some money because it did make a new high. But now it's looking very weak. I mean, we just took out that support that we made in September. I think it was around 15.5. And we took it out today. So, I mean, people are now looking to buy downside puts. But long term, it is a bull market, and it has been for 8 years. I had people 2-3 years ago that said it was going to go up to this level, and timing is everything. It didn't make it at the time they were buying these out of the money calls. A lot of people made money. There's definitely still some money to be made in these metals.
So unlike Netflix, where everyone was hitting the bids and every put they could find, everyone was scrambling to buy upside premium in gold. There was no preponderance of downside premium sellers. In this
no, I think for retail, selling puts was a more complex strategy, and they see limited gains with a limited risk, and they say, well, gold's going to the moon, so I can have unlimited gains. Why would I ever want to limit my profit?
Buy maximum of these 1 delta calls.
You guys take credit cards,
You guys take credit cards.
10 deltas, that's too deep. Let's go high.
Come on, wuss.
Why am I wasting all this money?
Fractions of a delta.
All right, so that's pretty much going to do it unless there's any other interesting trends you guys thought of or that you noticed with your clients or your customers this year that you thought was interesting and worthy of note here on the show. Anything your clients or customers were coming to you with that we thought was intriguing?
The collar didn't seem like such a bad strategy in August. A lot of times when we're in a raging bull market, we get phone calls saying, well, why are we so overhedged like this? But magically didn't get a lot of those last fall.
Definitely a good environment for the KYO boys because this is the proving ground for your very cautious strategies. I can imagine a lot of just straight up markets. People will be calling up saying, why are we wasting? You can't see my air quotes, listeners, but why are we wasting premium on buying any sort of protection? But when you see these vacillations that we've been having, I think vacillations is an understatement.
Yeah.
These systemic shocks that we've been seeing in the marketplace now. You'd have to be a pretty foolish client not to see the value of putting a few basis points here or there towards some downside cushion.
Well, it is. The market's going to do what it does in the short term, and with it is the fact that we were able to make the hedge section profitable on gold over the course of the last couple of months. Obviously, the account value went down, but it's one of the ones to where if you have a long-term view on something, we're caught up, and this whole journey that we've had in gold, we've been pretty well protected, and this is where it catches up in markets like this.
All right, and that is going to close out our trading trends of the year. And now we're going to roll into another little segment where we talk about some of the interesting stories and developments that we saw over the course of the year. All right, and welcome to our, I guess you can call it our big option stories segment. We, of course, do a lot of headlines, a lot of breaking news on the Options Insider throughout the year. We're able to track a lot of that and see what people are interested in and what people are clicking on. And there's a few big stories that really seem to catch a lot of people's eyes this year in the options market. And we'll start off, I think, with one of the big ones, one of the interesting ones for a lot of our listeners, and certainly one that we've been debating in the industry for a long time and hearing about and wondering if it would ever actually happen, which was, of course, the launch finally later this year of the SPXpm, an actual electronic SPX product. And that was one that, as a former SPX pit trader myself, I didn't think would ever happen. I know how powerful that pit is and how big it's become, and the inertia of some of those large floor traded products to resist the encroachment of electronic trading in any way, shape, or form. And so the fact that they were able to get this done in any way possible over at, or in any way, shape, or form over at the SIBO, I think is very interesting. And of course, I'm also, this is an institutional product because it is a larger size product. But one of the interesting tacks they've taken with it is that they're obviously going after that sophisticated retail guy who started trading VIX a lot over there. If you look at a lot of the marketing, they're trying to say, hey, why are you wasting the commissions buying 10 spider options? You can buy one SPX option. And that is obviously aimed at some of Mr. Grigas's folks over there who are calling in. So I guess my question to you then, John, would be, have you seen any sort of uptake, any sort of interest from your more active retail guys in this SPXpm product since it launched?
Not as much as I expected. I was on that panel for the SIBO in September, and you're right. They were trying to do a comparison to the VIX, and their big thing was the multiplier, and you could see the open interest on a at-the-money call in the SPY is in the 50, 60, 100,000 on a busy day. Obviously, we're in the holiday markets this week. We've pushed it. We've emailed all of our clients that are active in the SPX and in the SPY. We've put headers on the SPX chain and on the options chains page on the website. And I think you can see the volume yourself and the open interest on the SPXpm.
Obviously, it's a holiday week, but what kind of numbers did it put up? I don't have my list in front of me here.
An open interest on the January calls less than 1,500. Volume. Now, like I said, it's a holiday, but we're talking 120 contracts on the call side. I mean, very.
Granted, that's a 10x multiplier, but still.
Correct. But when you compare it to the SPX, and we do have sophisticated traders that sell premium in the SPX, and I've talked to them on the phone, and I think it's a catch-22. They're wary to trade it because there is no volume, there is low open interest, and they are trading 50, 100 contracts at a clip, and they want to wait to see if more people go into it before they kind of test the markets, and it's kind of giving the SPXpm a slow start. I think longevity-wise, it will be a good product, though. I mean, the bid-ask spread at the money, we're talking 80 cents. It's very tight.
Yeah, we talked earlier. You can kind of look at the SPXpm and see the way that the floor was fading their positions in the big pit as well. So maybe there was some concern that people would be getting picked off by trading in the electronic product, maybe exclusively. But yeah, you're right. I haven't seen the same level of uptick or the level of uptick that I kind of expected with this product as well, given all the hullabaloo about it finally launching, particularly in and amongst the options business here. People have been waiting for this for a long time. I think a lot of people thought this would be a real big mover of the needle, and at least so far. I mean, some of the institutional guys started to pick up on it because it does allow a certain ease of execution, that calling up on the floor and having the open outcry stuff and running through all the various the quotes and getting a market and getting back to them. There's a little bit of ease of use on that. Of course, I think a lot of the big paper in SPX still is very complicated, 1-by-3 ratio straddle swaps and stuff like that, and it's all tied, and that's hard to put up on that sort of electronic book yet. So that's probably hampering it a little bit, I would think as well.
Yeah, the whole C2 exchange seems to be geared towards retail outright buys, easy verticals, stuff like that. Nothing too complicated, but I believe it will take off. It'll take some time. I got to imagine those floor traders feel a little more assured of themselves.
Yeah. It's surprising. Maybe it's part of the thing too that helped kill the single stock futures, that the brokerage firms kind of weren't a big fan of promoting them because they hurt the margin. A lot of firms have been pushing the SPYs and things on a commission basis for a long time. Maybe they're reticent to dive in full bore in promoting the SPX options because it does kind of eat into some of their commission revenue. I mean, I'm glad to see that OX is diving into this product full bore. Maybe some of the other ones out there aren't as, let's say, outgoing in their support of the electronic version of the product. I think there's probably a lot of reasons why this hasn't caught on. Certainly not to the fall of the SIBO. They've been pushing it everywhere. If you've been to the Options Insider over the past few months, you've seen a lot of ads pushing SPXpm, and so they're definitely putting a lot of effort behind it. It's interesting to see how this translates as it goes on a little bit and how much crossover they can get from that VIX lightning in a bottle that they have over there and bring that into the electronic SPX. But you, Uncle Mike, have you looked at this at all for any of your clients?
Not too much, no.
There it is. That
Let him get a sip of his beer. Hold on.
that pretty much puts the icing on the cake right there. That's the exclamation point for the SPXpm discussion. The other one that was a big deal, obviously, for our audience and some of our people on the panel, actually, was, of course, and we'd be talking about this regardless of whether or not this was an OX show or not, but this is probably one of the other big deals, was just the Schwab acquisition of OX this year.
Wait, the what?
Oh, yeah. You didn't notice your checks have changed? You need to go back and really go back through orientation again at the office, sir. There's a lot you may have missed while you were sleeping over the past few months. A lot of general trend we've seen overall of a lot of consolidation in the retail space, and interesting one to watch. And it's still early days for the Schwab deal. It only had day one, a few months ago. What was it, back in September?
September 2nd?
Yeah, September.
Yep.
So
I was on vacation.
Way to impress the bosses there.
Yeah.
Maybe that's why you missed out on all of what's been going on over there. But yeah, interesting trend to watch. I mean, this is one I think that's worthy of highlighting because we have indeed seen so much interest in it on the options insider over the past year of these firms acquiring each other. But in terms of the impact, we've obviously seen what happened with the TD and TOS deal going forward there, and we'll have to. Interesting to watch as the Schwab one continues to see how it unfolds. Because it still is so soon. You still are two essentially separate entities in a lot of ways from a lot of people's perspectives. It'll be interesting to see how that merges and comes together in the coming weeks and months, or in years, as we should say. I know we're certainly looking forward to having the option block permeating every single Schwab entity out there, website, app, you name it. So that'll be I think for our listeners the chief concern and the chief benefit of this deal. Speaking of acquisitions and just M&A in general, I think the other side of the coin, the institutional side of the coin that a lot of our institutional listeners and the people in the business have been watching, I think a lot of higher-end retail, because they're growing more savvy in this space as well, have been watching, as of course, the old Deutsche Borse NYSE deal, and how that's been that battle going back and forth, and why that's interesting, particularly for us in the options realm. I know we've touched on it a little bit on the show in the past before, is that it really combines a lot of options liquidity under one roof for the first time. I mean, we've seen in the past exchange mergers bringing two exchanges under one roof. So you have NYSE with Amex and NYSE Arca. You have NASDAQ with NASDAQ OMX and Philly. So it's not unusual for exchanges to have two exchanges under one roof. Now we're looking at having potentially three all under the same banner. You have the ISE, NYSE Arca, and Amex all under the same banner. And I think for a lot of retail traders and institutional as well, it's curious to see how that will play out. And a lot of people betting which of those exchanges, if any, will be merged into the other two, and what technology they'll keep, what personnel they will keep, if they'll keep them all running as individual medallions, or if they'll make some sort of changes. My money's on the latter, but I think we'll see how that shakes out. And that's just been delayed until Q2 of next year and going into March. I think end of March, so end of Q1, beginning of Q2. So we'll see how that plays out. But there has been a lot of concern from the retail side that sort of consolidation will start to impact them. I think some of the savvier ones are realizing, as they start to dig under the hood a little bit of their executions and see how these things go up and who is kind of really putting behind the curtain, so to speak, on a lot of these trades, a lot of the savvier people out there are starting to be curious. And in the day, 4 or 5 years ago when we launched the Options Insider, none of the retail people would ever have any interest in these kind of deals. It was just another M&A deal in some big exchange space. But now, as they're actively looking at their spread, sitting in the spread books on various exchanges, they're starting to realize that what the different entities out there and their impact on their trading and how that might impact them going forward. So this was definitely another big story. We watched a lot throughout the year. I think a lot of our audience was interested in. I think still is, obviously, as it keeps getting postponed, still too early to see how that's going to shake out for the next year, but still interesting one to watch. And like I said, I think my money is on one of those three entities being perhaps consumed or subsumed into the other two, as the case may be. And finally, I think we don't touch on it that much because it's not particularly an option story, but it's been all over everything you've ever possibly read in the financial world for the last few months. That is, of course, the MF Global fallout and just general debacle. I know that made your life a little interesting for the past few months, Mr. Grigas over there. Has that started to settle down finally?
It has started to settle down. I mean, it's kind of interesting because every few weeks you hear another story about, oh, hey, look, we found the money. It's at Chase.
Now really found it. No, it's in John Grigas' backyard.
Yeah, it's Jimmy Hoffa had it right next to his, behind or beneath the Giants Stadium. And then I heard that they had it in the UK. But I mean, for 3, 4, 5 weeks, we were on call because we thought these accounts were coming over. So I was staffing on the weekend, and I called people on Saturday and said, you don't have to come in. It was talking to customers that weren't 100% aware of what was going on with the MF Global. What do you mean I'm taking a 20% haircut on my portfolio? I only owned options. I had to tell people that, and it was tens of thousands of dollars, and it was tough, and they, had put their money into something that has been secure, trading futures and futures options since the late 1880s. No one has ever gone into this situation, so it was tough to talk to these people, and we're all traders here, so you kind of felt for them a little bit in the fact that you earn this money, you go into.
They didn't do anything wrong, they weren't out there slinging downside puts in Netflix or anything.
No, they weren't risk adverse. But I mean, then you see Corzine on the TV, and I didn't know. Get a little tired of the CEO doesn't know what's going on in his
until
own company.
Terry Duffy from the CME threw him under the bus. That's very same day. I think. Oh, he knew. Some guy I know told me that he knew over at the CME, and so. Yeah, that was interesting to see.
But I mean, as a whole,
Dave's like, we're not going down for this.
You're not taking us down with you on this one. We're throwing you under the bus, hook, line, and sinker.
And I think he was right to do that. I mean, it was a one-off thing that has only happened once in this decade-long or century-long industry. So and I don't feel it's going to happen again. But it hurt everybody.
Yeah, and just to close out on the whole MF Global thing, just for a minute. I know we're used to in the derivatives world dealing with a scandal on an almost bi-monthly basis at this point. Some rogue derivatives trader wiped out X bank or did something else, or derivatives are being blamed for the starvation in Africa or whatever the case may be. But it seems like whenever you talk to people in the business on this MF Global thing, particularly on the futures side, they're really pretty concerned about it. They think this could really be the one that really sets everybody back a substantial ways in terms of impact and bringing in a lot more regulatory oversight, perhaps needlessly so, and having a very significant negative impact for a substantial amount of time to come. So, like I said, we haven't touched on it that much, but it's been very popular on our website, and a lot of other publications. I can plug my friends over at Futures Magazine. They've done some really good work on covering this story, so check them out over at futuresmag.com to read more about the whole MF Global debacle. But definitely a very big story that's been taking up a lot of the oxygen in the room over the past few months. And before I close out this story segment, any other interesting, developments or stories you think were worthy of note for this show?
Oh, we saw a lot of IPOs in social media this year.
That's true.
And valuations that were skyrocketing, and as we got closer and the SEC looked, and hey, maybe you're reporting 2 times your actual gross revenues. That's not.
Could you be referring to the Ponzi scheme known as Groupon?
Yeah, which I sold some put spreads in, and I did all right. When it had a dead cat bounce at some point.
When it finally rebounded, it was looking a little dire there for the premium.
But I mean, like LinkedIn, I found a lot about short selling rules on LinkedIn. Hard to borrow stocks because everybody wanted to short that over 100. And social media made a big imprint on the IPOs this year, and it was good to see IPOs returning to the marketplace. Not sure if the quality of these IPOs were definitely what the market wanted to see, though.
It had that feel of 1999 again, where what does it do? It doesn't matter. It's tech. Buy it,
What was the pet one?
Pets.com? Yeah, with the sock puppet. Yeah. That's a famous. Yeah, but you're right. It has been a big trend and a lot interesting for us because a lot of people coming in looking to leg into conversion reversals for nice profits, given all the put premium that's been going into these trades quite a bit. All of these names opening up with substantial put premiums just because you can't get short, and everyone and their mother is trying to get short these things, legging into put spreads. Of course, saw some people like we saw in Groupon coming in saying, these puts are so juicy, I have to hit them. And then for a while there, like, how can I get down to the 15 handle? And then sure enough, it danced around there for a while. I think a lot of people were thinking, oh no, Netflix Part 2. It has since rebounded a bit, and Mr. Grigas can hold on to his home for another week. But
back to the state college.
There we go.
No community college.
There you go. Moving on up the chain again. Moving on up. But yeah, so that has definitely been an interesting trend as well, as the return of the IPO, lackluster as they may be. I mean, LinkedIn, hovering around 60 now. I lost track of Angie's list where that one went as well.
Zynga come out.
Zynga, you're right. A lot of just great ones and great, maybe overly attractive to the premium selling side of the audience, and hopefully a lot of them hedged their bets, so to speak, so they weren't completely whipsawed like in the some of the dances or the movements we saw there in Groupon. I was going to, for this show, do a big rundown of all of the really interesting, unusual activity we saw in the odd block over the course of the year. A, I realized, one, that's a hell of a lot of stuff. It would take forever to do that. And then B, it was really, what we saw throughout most of the year in the odd block this year was really emblematic of one trend and kind of the mantra I've been saying over and over again in the odd block since we started this show is that the size money is not always the smart money. I mean, we've seen how many examples of that over the past
lottery
year.
tickets.
Everything is lottery tickets. In fact, I went and looked just for curiosity. What was some of the first stuff we talked about in like the first show in January of this year? And sure enough, it was some people coming in loading up 15,000 and another 10,000 in Feb of just 25,000 upside calls in good old Radian. Remember that one, RDN? They were gobbling up. This was like our first or second show in January, gobbling up RDN calls, 15,000 of the January 9s for 35 cents, another 10,000 of the Feb, Jan 10s are getting lit up, Feb 10s being purchased for like 15, 20 cents. I think Sebastian and I even went in to sell some of these things because it was just so ridiculous and give some people some upside out there because they were so desperately craving it. Of course, where's Radian right now? $2.25. So I think that trade in and of itself is just emblematic of a lot of the size paper we saw going up this year.
The oil 200 calls.
Yeah, the oil 200 calls.
Yeah.
I was going to put those in there as well, but we talked about them already. That's also emblematic. You know, we hear so many people out there think, oh, well, the smart money is the size money. I'm going to follow them. These guys know what's up. And we highlighted a number of those ones that seemed dubious at the time. You know, the guys loading up on just a few months ago, was it with RIM, I believe, where they were loading up on weeklies and 1 day to go calls because it looked like they knew something was going on in RIM in a couple of days and takeover chatter, and that all went out worthless. And he loaded up on 1 day and like 1 week options on the upside. They all went out worthless. So
we ticked off all of our Canada listeners.
Yeah, exactly. We got all of the RIM patriots angry at us up there and in the frozen north. But yes, that's definitely been the overall trend. I thought the RDN trade was a perfect way to embody what we saw so much of. And not even were they losers, but they were so unsophisticated. You know, they weren't doing the the ratio risk reversals or any sort of iron condor swaps or what so many of the people think the big money is doing out there, doing these really sophisticated trades like they are putting up in the S and some of the other places. But here, so much of this quote unquote pick-off paper is really just, like you said, loading up on 20 Delta lottery tickets and watching it go to zero. If I counted how many of those we had in the odd block over the course of this year, it would be a good substantial number. So I thought rather than spending 2 hours going through each of them, the listeners can go on the Options Insider if they want to hear more about that. We'll probably have some write-ups on the site as well, outlining some of the interesting trades we saw going up. I thought the RDN one was a great one, just emblematic. Everyone buying, couldn't get enough Jan 9s and Feb 10s and Jan 10s. And granted, they even by the end of January, those calls were losers, I think, off the bat. They never looked back on those ones. It was fantastic. I don't think it ever even hit 10. I think it got even below 2 for a while there. This thing was just a dog. So, yeah, that's pretty much been the trend. And before we close it out, I'll give everybody here a chance if they want to go out on a limb and make any sort of interesting predictions for instead of around the block, we'll do around the year or the year ahead for what we're seeing here. And Andrew, maybe we'll start off with you because you are on the cell phone. Anything? What? Obviously, VIX hovering here now around the low 20s. A lot of people, myself included, had gone out and said that we were at a new mean around the 23 to 25 range, and looked like I was wrong because we were headed much lower than that. You think this is we finally found the new mean here? Or?
I want to say like 18 to 30 for the year.
Bold man.
Wow. That makes Tusaw look courageous with his 40.
You should go into politics.
Yeah.
I do think we'll see the teams again. I don't think it will get much lower than like the 18 to 19 level until the Europeans actually do something. Everybody knows they got a problem. Everybody knows what the problem is, and they're all looking at each other. So until we actually break that log jam, and we start auctioning off tons of Italian bonds again for 4% or 3%, I think the VIX is going to have a hard time breaking through some of those lower levels. Unless we that's it. I really think it's going to be tough.
Yeah, given how long the VIX maintained in that mid-30s range and above, I'd have to imagine that there'd be a floor here somewhere around the low 20s, high teens, where people will just come in and scoop that. People were buying VIX in the mid-30s for a long time, even though it wasn't warranted by the movements of the underlying. So people are going to have to start coming in, and if you loved it at 35, you gotta love it at 18, right?
That's right.
Right. Until the scars of selling it there have gone away, it's going to take a little bit. So I think this will be the year of more of a range working on the downside until we can actually get something going on so the Europeans can solve something.
So you think like Netflix, or so many of those people got burned and they just kind of took their ball and went home. Same thing with the short VIX guys. They bet so heavy back in October, and then they rolled and they got burned and they got burned so many times that they're just out of the game for a while now.
I think they're gonna be a little more patient the second time around. It's hard to be aggressive and wrong after you've been smoked already once to do it again. So I don't know. Generally, it's like kind of a dog. If his nose too close to a flame, he doesn't do it the second time in general.
Well, that's an Uncle Mike reference there. The dogs and flame. That sounds like an Uncle Mike Tusaw. Country wisdom for our listeners there. But yeah. Oh, good.
No, I'm just saying, Maine. We do have our country wisdom here. I claim it is the only third world country in the United States with good roads. That's what Maine is like, I think, essentially.
And tasty, delicious lobsters, don't forget.
Tasty, delicious lobsters.
All right, anyone else want to leap out on some predictions? I'll come out, too, and I'll say I think, we'll just do over-unders and make it easy for everybody on the where we are in the SPX and in the S&P right now. And I'm just going to come out, surprise, and I'm going to go on the underside just because I have been a doggone bearish. And these levels are not exactly floating my boat, so to speak. So I will come in and I will take the under. And anyone else want to join with me? You guys, I know Grigas, you're like a diehard bull these days. You thinking what? You thinking what? 1,600 in the S&P by next month, right? That's what you're saying here?
No, I think yesterday was a back the truck up to get some momentum through the 1,300 level. If you look at the first week of October, we've had higher lows. Technically it looks like we're about to break out in either direction. But I've done metrics on my own trading, and 9 out of 10 of my trades are buys. When I'm trading futures, regardless of what they are. I'm always a bull. I'm always optimistic. Mark Longo is bearish on America, so that's why he chooses to take the under.
You're always a bull, always optimistic.
No, technically it looks like we're going to break out.
This is the new and improved John Grigas here.
I am not a long-term trader, though. I mean, I love the weeklies. I love the swing trade. I love getting in and out, day trading. Brokerage firms love me. My P&L for usually the end of the year is I break even, and I've got thousands of dollars in commissions. But right now, I'm looking to get long. I was long yesterday. I bought some at the money calls in the last hour, and then I closed them out right at the close. And been kicking myself in the butt all morning long.
That's what's so hard about making longer-term predictions for this audience, because so much of our audience is exactly what you're saying. They're in and out day to day. They're trading in and out on a regular basis. They don't care what the SPX is doing next December. Right now, they want to know next week, next 2 weeks, next tomorrow. They could care less December. They'll care about December in next December. And what about you, Uncle Mike Tusaw? Where do you fall on that side of the equation?
I'm gonna take the over but I'm gonna place a side bet for. I'm gonna hedge.
Here we go, hedging. 48% guarantee.
No, my side bet is I think we're gonna be relatively flat until we get a clear picture of what the elections are going to look like.
We should see where. I think we do have an election year this year too.
Year-end rally is what I'm saying.
Probably will be a little bit. Where did we close today on the S&P? Just so we know exactly where we're.
1260, I believe.
1263.
1263. Okay, so I'm picking the under. That's true. The election does throw some. I think we're going to have an interesting wrench into that.
I'm saying flat until the year end, and then I think we're going to rally.
You did see, we didn't mention the big developments or potential developments of the story, but you did see, Nadex is thinking about having an options market for the elections. They're filing to get that now, so that might be interesting if you can buy a vertical on Romney, let's say, or something like that.
Long Romney, short Paul.
Yeah, there we go. Spread them. So that'd be some interesting fodder for the show, I think, as well. Well, I think with some
unusual activity, people are buying calls on Hillary.
Yeah, exactly. What is this? Out of the blue, is she going to run again? What's going on? Yeah. Last minute Hillary bid. People saw it first in the options. That'd be great to start doing some odd block on Ron Paul upside calls, lighting up the tape or something crazy. Downside puts in Obama today, lighting it up, something silly like that. All right, and that is going to do it for our year in review, year-end special edition of the Option Block. I'm glad we all got to come in and sit around this fine oak table here and sip some fine adult beverages and discuss the year that was in options and, of course, the Option Block. And before we go, it wouldn't be proper if I didn't give each of our hosts, first off, thank you all for being such a big part of the show this year. We obviously, quite literally, Could not have done it without you. It would have been me just talking into a microphone, and we all know how fun that gets after a little bit. So having all of you on the show has definitely expanded the reach and the horizon and given our listeners other people to listen to besides me pontificating ad nauseum. So yes, I want to thank all of our hosts, including those who could not make it, including Mr. Sebas over there at Option Pit, as well as Rob and Tim over at Options Express for making the show such a success this year. And we look forward to doing more of these shows next year with the OX/Schwab crew and seeing what develops in the coming months. And before we go, let's give each of our people here, each of our co-hosts, one last chance to let our listeners know what's coming up starting off with you, Uncle Mike Tusa. What's coming up in the land of KYO going into this brave and bold new year?
Sign up for our newsletter, folks. We're going to have a lot of more detailed webinars for KYO newsletter people only. Go to knowyouroptionsinc.com. We have a lot coming out in January, and we're excited about it.
All right. And Andrew, aside from tasty, delicious Maine lobster, what is on your horizon over there at optionpit.com?
We launched kind of some intro courses online. We call them the Silver Course. It's been pretty well received by everybody. Just teach people the basics before we go in and we bludgeon them with volatility ad nauseum. Also, I think Mark and I will be doing a webinar in January for TheStreet.com. He's out and about everywhere, and it was a very good year for Option Pit. And we're looking to continue to grow and continue to grow our Option Pit Live, where people can log in every day and hear the musings and wisdom of Mark and myself and reading the market live. So that's actually been a growing, successful product too. So just we've launched some really great things, and we look forward to doing more of it this year.
Stories of growth all around. And I think most importantly for you guys over there, how have the Slinky sales been?
The Slinky sales, they were the hit of the money show. Everybody was walking around with an Option Pit Slinky.
Why am I not surprised?
So Slinky is here to stay as far as the swag for Option Pit. It will never go away.
It's part of your branding now. It should be your logo.
Somehow, I'm sure it will get in there.
You can have a pit with a spring springing out of it. There we go. And last but not least, Mr. Grigas, what is coming up on the horizon for the land of OX, and what will intrigue our listeners?
We're hitting the road again. I think I mentioned the first two, but I'll go over them quickly. We do live free workshops in various cities around the country. Saturday, January 14th, will be in Dallas. January 21st, we'll be in Sacramento. In February 11th, we'll be in Minneapolis. That's going to be a nice one to travel to. And then
sunny Minneapolis. You can hit the Mall of America, though, at least, and have some fun shopping. There you go.
Head over to Indianapolis on March 10th, so a little bit of a gap there. But those are the upcoming live events. They're all free. They're about 6 hours. I think Tusa was a big push on getting them established back in the day and then to the great
many
thing
frequent
they are
flyer miles. Just a true story. I still have, even 2.5 years after the fact, I still have one more night left in my frequent Marriott card from all the traveling I did at OX.
Very nice. One other thing I wanted to mention, too, yesterday on the train, I saw something I've never seen before. I didn't even know this book existed, but I think it's a telltale sign to where derivatives and futures and equity options are going. I saw a gentleman reading a book called Options and Futures for Dummies. And so I had to mention something to him.
They do exist. We looked at when we first were thinking about, before we did the Options Insider, I was thinking maybe I'll do one of these dummies books. And I looked into them, and there were several already out there. And I thought, well, that road has been hoed. which way should I go instead? And history was written.
But they must have a topic on everything. But I said to him, and if you're reading that book, you probably need an account at Options Express.
Here's my card. Get this Grigas special.
You get 20 minutes of phone conversation that'll cover that book. So I think it shows that the main options and derivatives are going mainstream for 2012.
There you go. The dummies. If they see it on the train, anecdotally, it must be so. All right, and of course, everyone out there, I want to remind you, if you want to read more about any of the stories we discussed today or any of the stories we discussed this year, then surf on over to theoptionsinsider.com. And, of course, on a personal note, I just want to thank everyone out there for making the Options Insider and, of course, the Options Insider Radio Network such a success over this past year. And we'll look forward to adding even more new programs and more new content for you on the website and on the radio network in the coming year. So with that, and on behalf of the entire Option Block crew here, I want to say thank you again to everyone out there for downloading and streaming and subscribing to this show and making it such a success. And we'll see you again in 2012.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.